This is Financially Fit Radio with Cory Sickles from Safe Harbor Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Cory provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Financially Fit Radio with Cory Sickles.
Welcome back to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Retirement Group and Wealth Advisors. If you would like any information about anything we discuss on today's show, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, feel free to click on that radio page. You can check out some past shows, as well as subscribe to our podcast on Apple Podcast, Amazon Music, Google Podcast, or Spotify. Also, you can visit our YouTube page. Just type in Safe Harbor Retirement Group. You can watch today's episode as well as previous episodes on there. And you can also subscribe to make sure you're up to date with any type of video we release. We do 3 or 4 shorts a week about different types of financial topics. Again, we're here to help and guide you to make sure you have the best retirement that you possibly can. Again, you can always give us a call at 614-760-0670. or visit us online at safeharboroh.com. And just remember, if you schedule a meeting with us, the meeting's complimentary. There's no financial obligation. And again, we're here just to help you. Today, we have an interesting topic. It's something I think a lot of people have good thoughts about and bad thoughts about, and that is fixed indexed annuities, or the word annuity. And what I really want to do today is just kind of go over some of the pros and cons of that to make sure you understand how it can really benefit you when you start, preparing for a retirement. Now, let me also introduce to you my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
Oh, I am doing great, Cory. Had a great week. Just kept really busy, did some things with the family. It's been a fun one. I love the fall weather. I love it when it's a little cooler outside, not as hot as summer, not rainy. The leaves are turning, and not winter. That's the key. It's not winter, right? That's the good part of this whole thing. I am amazed at the topic you have for us today. It's so important, and I'm glad you're going to clear things up, because I think that fixed index annuities are one of the most, annuities in general are one of the most misunderstood things out there. And there's a lot of preconceptions and misconceptions about annuities. Not all annuities are created equal. So we're going to dig into that. But first, how have you been? I know you've been busy, haven't you?
I have been busy, Tony. I love fall too. There's nothing, I like to run or walk in the mornings, and it's a lot better when it's in the 50s. Yeah. Personally, I think that, I do like to, I believe me, I'm not a winter, and I know your winters up in Minneapolis are a lot worse than we get here in Columbus. So, it's about ready. It comes a lot sooner for you guys as well.
It does. Yeah. And the older I get, the less I like it, Cory, the winters.
Oh, I know.
Yeah.
But, there's a lot of hurricanes down south.
Oh, yeah. It could be worse. I feel for those people.
Yeah, I feel bad for them. And, it's busy. This is really, once October comes, we really get busy October, November, December. There's a lot of people that are now, kind of just really focused on retirement, or we have a lot of people coming in that want to retire within the next 6 months as well.
Yeah.
The end of the year, first quarter is always a very popular time for people to retire. Yeah. And, part of this, and I think it kind of leads in today's show, Tony, when we start talking about annuities, and, there's different types, we have fixed, for example, right? You can get a guaranteed rate for, 2, 3, 4, 5 years of a certain amount. You can also do a variable annuity. We don't recommend those. Usually they have higher fees. You're still invested in the market. You might not have a whole lot of protection on the downside of it. And then we have, I think, which is our most popular, which is the fixed indexed annuity. And so we really only do fixed, or we actually do fixed indexed annuity. So, so with a fixed rate, you get it's kind of like a CD, right? So you're going to get a certain amount. You're going to be guaranteed a certain percentage for a particular term, whether it's 2 years, 3 years, 4 years, or 5 years. With a fixed indexed annuity, the index means you get to invest in the market. Now, obviously there's good and bad with that, right? On the good side is when the market goes up, you're going to be able to make some money. We'll talk about caps and all that type of stuff here in a few minutes. But when the market goes down, the nice part about a fixed indexed annuity, Tony, is your principal is protected. You're not going to lose any money based off of the principal because of the market down loss. So it's a good way to be able to be in the market, but also have protection with that as well.
So if I put $100,000 into a fixed indexed annuity and the market drops 20%, I still have my original $100,000 in there.
You do. And the only thing that might be different on that, and we'll talk about this, in a few minutes, but you might actually have a fee associated with that.
If there's a rider or
if there's a rider, and that, of course, then you might lose the fee. But based off of your principal, you are correct. You will not lose any principal based upon market performance on the downside.
But if the market goes up, I get to participate in some of that up to a capped level. Like if the market goes up, if my cap is 15% and the market goes up 10, I get the 10%, right?
That's correct.
Yeah.
And really so the nice part about this, let's talk about the cap for a second. So a lot of times caps, Tony, are dependent upon what the annuity company or the insurance company can do with your money. And they have to invest that in safe investments. And a lot of that's based upon the U.S. Treasury. Well, what's happened with interest rates over the last 4 years?
Yeah, they've went up,
which means these products or these caps actually get higher. So there's caps out there right now ranging in I'll just say from 5% to 10%. So, if the market goes up 12 or 15, yeah, you're only going to make 10%, but it's better than what the products were, 5 or 10 years ago. Yeah,
sure.
And what you have to remember with that, Tony, though, is you might get a 10% gain, right? Maybe you didn't get the 15 because the market went up 15, but there's a cost associated with that because if the market goes down 20, you lose 0, right? You can't expect to make what the market makes and have
no downside.
Have no downside,
no risk. Yeah,
that's exactly right.
Right.
So it's a good way to be able to lower your overall risk, right? You have downside protection, if the market does drop, and
so that would be one of the biggest pros to a fixed index annuity is the downside protection or the principal protection.
It is
versus just leaving that money in an IRA or investing it in the market.
That's that's exactly right.
Right.
I mean, the nice part about an annuity is what they use what they call an annual reset. So I'm just going to use a one year annual reset. All that really means, Tony, is, you put your money in today. I'm just going to say it's on November 1st. And let's just say you're invested on the S&P 500 and you have a 10% cap. So what it's going to do then is it's going to look at next November 1st. So whatever the market does in between there, whether it goes up or down or whatever else,
doesn't matter.
It doesn't matter. It's going to look at November 1st of next year. And if the market's up, say, if you have a 10% cap and the market's up 11, then you're going to make 10%. If its market's only up 5% during, at that point in time, then you're going to make 5. Now, obviously, if it's down 20 or down 10 or down any type of negative, then you're just going to make 0 that year. And there's a little saying with that too, Tony, zero's our hero.
Yeah.
And really what we mean by that is, hey, I didn't make any money, but I sure didn't lose any money when the market was down.
Yeah, if we had another 2008 or 2022, or we had a really down year, you don't need to worry. And that's why this vehicle is so appealing to people preparing for retirement or in retirement, because of that principal protection. And I think one thing, Cory, I really want to address as well. I've heard bad things about annuities. It's really, they've really changed. The fixed index annuities keep getting improved, little to no fees. And I think you mentioned a variable annuity earlier. And those variable annuities are, I think, what gave annuities a bad name because they had high fees. Plus, if the market went down, you could lose principal. So that wasn't really a good fit for a lot of retirees.
Yeah, and so there's really two. When we start talking about negative things, Tony, I think there's two things that usually fall into place. Well, I'll say three. The first one is fees, right?
Yeah.
So you need to make sure that you understand the fees. But I think with a lot of with all the clients that we have, we try to be transparent. We want to make sure that you understand the fees.
But you have fixed index annuities with very little or no fees at all, right?
That's correct. But I mean, but they do have fees. You just need to make sure that you know what it is, whether it's 0.75%. I think maybe some of the highest ones we see out there is about 1.2%.
Sure.
But that's usually with an income rider, and we'll talk about that in a minute.
Yeah, that's because if you want income from it, that's where the fees come.
Right. Yeah. But if you want an accumulation one, there's some out there right now that have a zero fee.
Yeah.
Have decent sized caps, and they might even give you some type of bonus to put money into it. There's some out there that give you like a 7 or 10 or 12 or 14 or even a 16% bonus, by putting money in there. So if you have $100,000, back to your example earlier, and if you're getting a 12% bonus, day one it's going to be worth $112,000, and then you invest, going from there. So just like anything else, we're independent, Tony. So when someone comes in, we're going to find out what you're really trying to accomplish. Are you trying to grow it? Are you trying to get lifetime income? And then we're going to go out and try to find the right annuity that's going to fit your needs based upon that. And it's being independent. A lot of times these different companies change their caps. They change their bonuses and stuff like that. So at that point in time, when we're working with you, we're going to find the best annuity for you at that point in time.
Yeah, and it's good because it's a competitive market, and these insurance companies say, hey, we want your money over here, so we're going to offer this really attractive, maybe a high cap or no.
That's exactly right.
No fee. So, or that bonus. So I think that's great. So let's go over some more pros, and then we'll get to more of the cons of the fixed index annuities. You mentioned principal protection. That's a big pro. What else is a big pro to a fixed index annuity?
Well, so before we start talking about the income, which is a big one, I think another big one, Tony, is potentially being able to defer the income, right? And I'm going to use an example here.
You mean tax-deferred growth?
Yes, tax-deferred growth.
Yeah.
And let me give you an example. Let's just say you have $100,000 and you put that money into a CD, and that CD is making 5%, right? 5% a year. So at the end of that year, you're actually going to receive a 1099 for that of $5,000 that you're actually going to have to put on your taxes.
The growth.
And if you do that for another CD the following year, you're going to have another 5% 1099 as well. When you put that money into a fixed indexed annuity, the same type of concept, let's just say you're getting that 5% growth again off of that. If you put that $100,000 in, you have a 5% gain, but until you actually make a withdrawal out of the annuity, you don't pay any taxes on it.
Oh, wow.
So it's a good way to be able to defer that growth until you really want to be able to maybe have access to it. Or maybe you don't need it at all.
Yeah, defer the taxes on that money until you take it out. And it's only the money, when you say a fixed index annuity, typically the money you put in, your principal, when you pull it out, that's not taxable. It's just the growth.
Well, it's a good question. Right? So you can actually, one of the things that you can do, and we talked about it on the show before, is you can actually put in what we call non-qualified money, which means you've already paid tax on it.
Sure.
You can put Roth money in there, and then you can put IRA money in there. So if you put after-tax money, or kind of like what you have in your bank account today, then you are going to defer that until you make the withdrawal, which is a benefit to you because your income's not going to increase until you withdraw that, which could be 5, 10, 15, 20 years later.
Sure.
With a Roth IRA, it works the same way. Money in, money out is tax-free, so you don't have to worry about any of that. And if you put IRA money into an annuity, it works exactly the same way. It grows, and then when you take the money out, you're going to be taxed dollar for dollar, just like you would in a 401k or
Because it's
IRA.
pre-tax money that you put in.
That's correct.
Yeah. Yeah.
But I think a lot of people get confused on what type of money I can put into an annuity. You can put any type of money you want into it. You're just going to be tax different based upon that.
Sure.
That's
so if it's money if it's money from a 401k or an IRA that you have not yet paid taxes on it because it's from a tax deferred account, and you roll it over into the fixed index annuity and put that in there, it can grow tax free, but when it comes out, or it'll grow, but when it comes out, you have to pay taxes on both the principal and the growth. Whereas if you put money after tax money from your bank account or from a Roth in there, then that's money that's not taxable. So you won't have to pay. You'll just have to pay on the growth.
Right. So you can put $100,000 in there. And if it's growing $5,000 a year and you don't take any money out, you're not going to see any type of tax or 1099. However, in year 3, if all of a sudden it's worth $115,000 and you take $10,000 out, that's considered growth, and you pay that. You'll be taxed on that $10,000.
Got it.
So it's a good way to be able to, potentially defer some of that tax, especially if you have a lot of non-qualified or after-tax money that's causing you maybe to go into different types of tax brackets on an annual basis. So the other part of I think one of the biggest, pros for an annuity or fixed indexed annuity, Tony, is the potential to have a lifetime income stream. So one of the things that you can do, and again, there's so many different ones out there, but one of the things that you can do is you can put money into the annuity, and some of these annuities have an income rider, and you might pay a fee. It could be 1%, it could be 1.2, 0.75. That's something that we sit down to make sure you understand when we're doing something like this. But it might be guaranteed to grow a certain percent no matter what happens in the market, right? So you can get some natural growth in there. And then the nice part about that, Tony, is when the time comes, when you want to start being able to take a lifetime income stream, then it's going to use whichever's higher, your accumulation or that growth of maybe 6, 7, or 8% per year. So on that income rider, now you're going to be able to trigger that for lifetime income. And the easiest way to be able to explain this, I think, to clients is, pensions. If you think about a pension, Tony, pensions were very popular, years ago, and some of you might be fortunate enough to have them now, but they're going away. So what this allows you to do is create your own pension. So you put money into it, it grows, and at some point in time, you can trigger that for a lifetime income stream. If you live long enough and the account balance goes to zero, you're still guaranteed that payment. As long as if you're married, you can do a joint income. So as long as you and your spouse live.
Wow. That sounds great. I can see where that would be a popular retirement vehicle. And I know that it's been a really popular vehicle, the fixed index annuity, with a lot of the baby boomers out there. And now some of my generation, the Gen Xers, are starting to look at those and get those as well. So what else about a fixed index annuity should we know? Are there any other pros you wanted to mention?
Well, here's the one thing that I would probably say. We kind of talked about it. At the end of the day, here's the way I would look at it. It's a good place to put money to be able to potentially have lifetime income, but it's also a good way to be able to protect your principal and as well as get some type of growth out of it. Those are really the basics of it, right? And there's a lot of different ones out there. The one thing that you really need to be able to do is sit down with an advisor, make sure they find the right type of annuity for you, which is what we do. But more importantly, you need to be able to make sure you understand why they're doing this and what the benefit is going to be for you. And I see a lot of people that come in that are prospects of ours that might have an annuity that have no idea how it works or what even the benefits of it are. And I don't expect my clients, Tony, to be able to know what it is totally, but they should have a good concept when they leave the meeting the way it works. And that's one reason why we do annual reviews, to make sure and remind them why we did this and where is it today, and when's it really going to become the benefit to you, or to your spouse, or even to your family.
Good point. And that's huge. And so do fixed index annuities include a death benefit?
That's a great question. A lot would, I think sometimes, when people Google things, Tony, it's not necessarily always good.
No.
You know what I mean?
Yeah, you get a lot of bad information sometimes.
You can get a lot of bad information. So here's the one thing I will say on this is, yes, a fixed indexed annuity does have a death benefit. Now, depending on what type of it is, depends on the tax consequences to the beneficiary, but there always is a death benefit on that, right? And there's different things where you can have different options on that, but that's part of the setup. Okay. But there is a death benefit. Here's the other part where I think a lot of people get confused is, let's just say I have $100,000 and I trigger, I have a lifetime income stream, right? And we're using an income rider. So let's just say it pays me $5,000 a year, and I use that for 2 years. Let's just say I don't make any money on it. I'm just saying, market wise, Tony, if I have $100,000 after 2 years, it's worth $90,000, and then I pass away. That $90,000 is going to go to 100% to your beneficiaries. So the entire amount of money is going to be used either by you, or it's going to go to your beneficiaries. So
it's not like you're risking it if you don't live very long.
That's correct. And I think a lot of people have that mind concept where they had to, what we call, annuitize the annuity. And if you're working with the right type of advisor today, they're going to give you an income rider. So you're never annuitizing it, which means you totally can control it. So if there's a better product, even 5 years from now, that makes sense to put you into, you can stop the income rider, move it into the other one.
Yeah.
So you still control it.
Yeah, that makes sense. I think that's great. And I think we should reiterate also the one other benefit that we briefly mentioned was, even though you mentioned the market with a fixed indexed annuity, there's no direct market risk. It's tied to like the S&P 500,
exactly,
but you're not directly invested.
That's exactly right. Yeah. So here's real quick here. I know we have just a couple minutes left, but let's just kind of talk about some of the negatives or the cons, because I think everyone should understand it. And I think, obviously you're going to have liquidity. And what I mean by that is when you put money into an annuity, you might only be able to withdraw, say, 10% out of that per year.
So it limits your liquidity.
So it limits your liquidity.
Yeah.
That's why if you're balanced the right way, then hopefully what you're putting into the annuity, you're not going to need, right? That's the first part.
Yeah.
Fees could be something. You need to be able to look at the fees, but that's one of the things we do with our clients. And I really think the third part, and this is where I think the annuities get bad names, is, back in the day, and this could be your parents, or it could be your, even maybe your grandparents had an annuity and something happened to them. But there used to be not a whole lot of regulation on how much money you could put into these products, right? Because these products, if you pull more than that, than what's penalty free, that 10%, for example, then you have surrender fees, maybe 3, 4, 5, 6%, right? And I think what happened is there was so much money into the annuities that they didn't have any liquidity. So in order to get the money out, now they had to pay the surrender fees.
Because it was within the term. There are no surrender fees on the fixed index annuity if it's a 3-year annuity and you wait 3 years. At the 3-year mark, you can take it out without penalty.
It's completely liquid. Yeah. But so obviously when we work with somebody, we want to make sure they understand what other liquid assets they have, so they don't have to dip into the annuity during the surrender time period. But I think that's where that's where it gets a bad name. And when you start Googling things, it's going to talk probably about customer service, or it might talk about surrender fees and things like that. But at Safe Harbor, there's really no reason for a client to talk to the actual annuity company.
Right.
They work with us. We're the ones that actually deal with the annuity company.
Yeah. Yep, and you do a good job. Now, we have to wrap it up, Cory. Why don't you let our listeners know before we go how they can set up that consultation to talk about this or ask questions?
Yeah, you can always give us a call at 614-760-0670, or you can always visit our website at safeharboroh.com. We're here to help and guide you to make sure you understand, not only annuities, but, anything about retirement. So, give us a call, visit our website, schedule a complimentary no obligation meeting with us. Again, we're here to help and guide you to make sure you have the best possible retirement.
All right, and that does it for today's episode of Financially Fit Radio. Thank you for listening to Financially Fit Radio. Don't pay too much for taxes or retire without a sound income plan. For more information, contact Cory Sickles at Safe Harbor Retirement Group. Call 614-760-0670 or visit their website at financiallyfitoh.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.